So today's Cardinal lesson, we're talking about long-term care insurance, and then we're talking about the income tax code as it relates to long-term care insurance. And so, Whoopi, we're going to talk about how you could possibly take a tax deduction for the purchase of long-term care insurance. And I'm going to let Tom talk about that.
Yeah, and so really the point of today's video is to walk through the tax benefits of these long-term care policies. One, from a premium standpoint, can I deduct these premiums? But more importantly, from the claims paying standpoint on the back end, how are these claims paid from a tax standpoint? And so I'm going to bring up the show notes. We're going to go through a little bit here, and then we'll get back to Hans to kind of talk a little bit more about it. But again, these show notes, you can find these at the link below on our video. They're also on our website. And so if you want more information or want to spend a little more time looking at it, go there to grab those. But kind of the first page of these show notes, I'll make it a little bigger here, is really talks about who can deduct the premium that they're paying for the long-term care insurance. And I'll just sort of jump to the conclusion is not a lot of people. But we'll go through kind of some of the specifics. And so if you're an individual person and you have an individual long-term care policy, the only way you can deduct a premium is you have to be itemizing your deduction. And then the premium counts as a medical expense. And so now you're under the rules around itemizing medical expenses, which the medical expenses have to exceed 7.5% of your adjusted gross income. And so there's not a lot of people that meet that anyways, but let's say you are in that category, you meet all of those criteria. This chart right here shows you how much of the premium you are able to deduct. It's based off age. Most people that are buying these policies really are in their 50s. And so starting in that bracket, 51 to 60, you could deduct up to 1,790, 1,790. Between 61 and 70, it's 4,770. If you're 71 or older, you could deduct up to $5,960. But again, you have to be itemizing deductions. Your medical expenses have to exceed 7.5% of your AGI. There's just not many people that really meet all of those criteria. Some other benefits, if you have an HSA, a health savings account, which we have a lot of clients that have those, you are able to pay the premiums for long-term care out of an HSA, again, up to these limits that are listed in the chart above. Some other common things that we run into are business owners. And so if you have a C Corp, these is really the most advantageous way to pay for the benefits if you have this situation. But if you are a business owner of a C corporation, you could pay the full cost of the long-term care premium as a business expense, and it's classified as essentially a health insurance cost, if you will. And so you can deduct the whole thing. What's also really beneficial for that is you are able to discriminate against class of employees. And so that's not necessarily like looking at race or anything like that, but a lot of benefits from a business standpoint. If you offer it to one employee, you have to offer it to all employees. Long-term care is not that way. You could offer it just for yourself. You wouldn't have to offer it to all of your employees. Now, if it's an S Corp, which is on the next page, it's not as advantageous. You are able to deduct the premiums up to those limits that were, again, on the chart above. And so ultimately, there's not a lot of scenarios that you're able to deduct the premium payment of the long-term care. If you're a business owner, there are some ways to do that. So if you fall in that category and have some questions, just reach out and we can explain all the rules and talk about how that might work out for you. One of the kind of later in the page, and this is where Hans is going to go into a little more detail, is we have actually the tax code 70. Let me get down here. Make this bigger. It's the 7702B provision in the tax code. And this where it talks about the taxation of the benefits. You qualify for long-term care, you're needing care. How are the benefits taxable? We've highlighted some of the important provisions in the code here. So if you're interested, print it out, look at it. We don't need to spend a lot of time reading through the whole tax code, but Hans is going to spend a little more time talking about these on the board here. But again, if you're interested, they're in the show notes. Print them out, take a look.
Okay. So this is the part that gets people's attention is they, people generally want to deduct anything that they can. So That's one of the first questions a lot of people ask us. Well, can I deduct long-term care insurance premiums? And the answer is, of course, maybe, like Tom was saying. The reason I'm doing a video on it, and it doesn't apply to a lot of folks, is because the taxation of the benefits, or Rule 7702B from the IRS code, states that the benefits that you receive out of a tax qualified long-term care policy are tax-free. And this is huge because, if you have inflation on these things and you've got, $6,000, $7,000, $8,000, $9,000 a month in the future in benefits, and you're getting $100,000 a year or more paid in long-term care benefits, it's very important that that is tax-free, and that if this goes on for several years, you're talking about $4, $5, $6, $7, $800,000 or more of all tax-free money coming to the very people that need it. So it's important to understand that, and it's not important that much for you to look at every long-term care policy and ask as if this is tax qualified. 20 years ago it was, because that's how old this provision is, a little more than 20 years ago. But most of what we sell, I could say all of what we sell, is tax qualified long-term care insurance, whether it's traditional long-term care or it's a hybrid. So everything we sell has this, and it just means that you're not going to have to pay taxes when you're old and collecting off of either home health care or assisted living or long-term care benefits. Now, not only are the benefits tax-free, but in order to get that, the IRS states in 7702B that the policy needs to meet certain standards. And those certain standards are like minimum standards. Like if the policy doesn't say this, that, and the other thing that I'm going to go over here, it doesn't meet the tax qualified status. So therefore the insurance company isn't going to sell it. So when people ask us questions like, is this policy really going to pay when I get sick? Or how are they going to determine whether you get paid? Or how are you going to, that's pretty much standard in all the policies we sell across the board, all the long-term care policies. Because if you read, that's why I put the tax code in there for you to look at. I don't expect that many people are really going to go to that and read it in the tax code, but I just wanted to put it there that if you take that tax code that Tom showed you that was highlighted, and you open up a current policy that we're selling, or you open up my policy that I own, which is a hybrid, it is almost word for word what it says in the 7702B of the tax code in these areas. So what we're going to talk about is chronically ill. Is what it says is substantial assistance or supervision needed for at least 2 of the 6 activities of daily living. And it specifies these right in the tax code: eating, toileting, transferring, bathing, dressing, and continence. Those 6 things are right in the tax code. You need to meet 2 of them, and you need substantial assistance. And just a little tip I'm going to give you here is I help a lot of people that are either my customers, or they're the parents of my customers, or they're people I sold the stuff to a long time ago, or they're just people coming in. I help them file claims on old policies. And generally what I'm going to do is I'm going to recommend that they use bathing and dressing, because you only need to meet 2. And those are things, as long as you need substantial assistance with them, why mess with the other 4? If the person needs help taking a bath and they need help getting dressed, you're good. And so the point I wanted to make was the wording of all this, because I've abbreviated it here, but the wording in the actual policy and the wording in the tax code, which we gave you a copy of, policy to policy, whether it's a hybrid or traditional, is very close. So this is the standard that the insurance companies go by when they design these policies. Okay? It also, in the model regulation, it states a whole list of consumer protections. So the IRS used this opportunity. They said, to the insurance company, if you want your customers to have the benefit of tax-free benefits, then you're going to have to include all this stuff in your policy at a minimum. And there's a whole list of things, but I wanted to show that it's guaranteed renewable, has to be in there. In other words, the company can't send you a letter and say the policy's over with. It has to be guaranteed renewable. And that is so guaranteed renewable as opposed to a policy that the insurance company could end. Now, there's a higher level of these things, and most hybrids qualify for this, or all hybrids. Is guaranteed renewable just means you can renew the premium or renew the policy until the end of your life, except the insurance company can raise the premium. And with a hybrid policy, it's non-cancelable. And the non-cancelable, so it's okay to be better than this provision. These are just minimum provisions. Okay, and policies before this time, the insurance company could actually end them. Then they have this unintentional lapse thing, which I don't want to get into a lot of details. It's in all the policies where you can name somebody they're going to notify if you don't pay the premium down the road, if you had memory problems, or maybe some older people just sit down with their son or daughter or somebody and they just decide, this thing isn't worth it. They're going to go through a lot of pains the insurance company has to before they lapse that policy to make sure that's what you really want to do. And then this whole business of post-claims underwriting, basically it prohibits it. And that's stated in the Model Act, and it's in the policy provisions. So you get all of this stuff because of the tax code. And then the taxation of the benefits is any reimbursement benefits, which most long-term care policies that we sell are reimbursement. Means that they will pay you once you incur the expense. Now, there are some policies that we offer which are indemnity policies. And what an indemnity means, if you qualify for the care, they just send you a check. You don't have to send in receipts to get reimbursed. That benefit is not taxable either, as long as it's not more than $420 a day. So that's 12 grand a month. You can buy of an indemnity policy, and if you qualify for benefits, they're just going to send you a check every month. And this goes up every year. So if you have inflation in your policy, in your indemnity policy, that was several years ago, that was $200 a day. So that, that goes up a little bit with every tax year that goes on. There's a increased amount for that. So when you look at the 7702B and you look at the whole picture, this is a place where the tax code is really actually working for you and helping you, the consumer, and protecting you, because the insurance companies couldn't sell these policies if they were not tax qualified. So the other piece that I want to show in there is it says in 7702B that the tax qualified annuity or life insurance / long-term care, this is the hybrids, that the linked benefits are tax-free. So, because life insurance is already tax-free at death, so if you buy a hybrid and you never use it, and then you die, and then your beneficiaries get the death benefit of the policy, that's already tax-free because that's life insurance. But what the 7702B does is it also justifies the linked benefits or the long-term care benefits within an annuity or life insurance. When they come to you, get the same provision as this thing does. So with that, I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.